Don't listen to Warren Buffett, Ray Dalio, Howard Marks, or Peter Lynch if your goal is to actually make money in the stock market. I know, that sounds like blasphemy. These men are legends. They've built fortunes measured in the billions. They've inspired generations of investors, written best-selling books, and proven over decades that they can beat the market. For many people, their first step into investing was sparked by reading The Intelligent Investor or watching Buffett's annual shareholder meetings in Omaha. Others studied Dalio's principles or admired Peter Lynch's ability to turn Fidelity Magellan into the best-performing mutual fund of its time. Their track records are not in question. They are the pinnacle of investing success. But here's the paradox. For most retail investors, imitating these strategies doesn't lead to success. In fact, it often ends in frustration, underperformance, or even financial loss. And this isn't because the legends are wrong. Their wisdom is timeless, their methods proven. The problem lies elsewhere, somewhere most people don't think about when they first open a brokerage account. Because the reality is this. The game that Buffett, Dalio, Marks, and Lynch played is not the same game you and I are playing today. And until we recognize that difference, retail investors will continue to fall into the same traps generation after generation. And that brings us to the harsh reality of what it truly means to be a retail investor. Most retail investors walk into the market believing they can replicate the success of Warren Buffett, Ray Dalio, or Peter Lynch. They read the same books, memorize the same quotes, and imagine that with enough patience and discipline, they too can build fortunes. On the surface, it feels logical. Follow the masters, reap the rewards. But the truth is far less romantic. The stock market is not a level playing field, and retail investors are entering a game that is stacked against them from day one. Institutions have enormous structural advantages. They can call up management, sit down with company executives, or send analysts to visit factories and distribution centers. They have access to real-time economic data, specialized research reports, and teams of PhDs running complex models. They know not just what's happening today, but often what's likely to happen next. Retail investors, by contrast, get their information from news headlines, quarterly filings, and earnings reports that are released to the public. By the time those headlines hit the front page of the Wall Street Journal or CNBC, the stock has usually already moved. Institutions position themselves hours, days, sometimes even weeks earlier. For individuals, the window of opportunity is often gone before they even know it existed.
Take Buffett's famous line, "Be fearful when others are greedy, and greedy when others are fearful." For Buffett, this isn't just a catchy slogan. He understands when fear is irrational and temporary versus when it signals something structurally broken in a business. He has access to management calls, private conversations that reveal the company's real condition, and decades of intimate industry knowledge to guide his judgment. That's why he can afford to be greedy when others are fearful, and cautious when others are greedy. But what about the average retail investor? What foundation do they really have to be greedy when others are fearful? They're reading headlines after the fact, watching stock prices plunge, and trying to guess if the company is facing a short-term panic or a long-term decline. Without inside perspective, their version of being greedy is often just catching a falling knife. This is why study after study shows retail investors underperforming. Dalbar's quantitative analysis of investor behavior has consistently revealed that the average equity investor earns significantly less than the market itself, often by 4 to 5 percentage points per year, because they buy late, sell late, and let emotions dictate their decisions.
The core point is simple. Retail investors are not playing the same game as the legends they idolize. The rules, the resources, and the information flow are completely different. Trying to mimic Buffett or Dalio without their advantages is like showing up to a Formula One race with a bicycle. It doesn't matter how hard you pedal, you're not winning. So if copying Buffett,
Dalio, Marx, or Lynch doesn't work, then who should retail investors actually learn from? The answer is straightforward: from people who started exactly where you are. Ordinary individuals who enter the market with small accounts, no institutional backing, and no privileged access to CEOs. These are traders who faced the same obstacles retail investors face today, yet managed to overcome them and build enormous fortunes. Take Jesse Livermore, for example. In the early 1900s, Livermore began trading with just a few dollars in so-called bucket shops, the retail brokerage outlets of his era. He had no research department, no access to insider calls, only price action and his own discipline. By riding strong market trends and cutting his losses quickly when he was wrong, he built a fortune that, at its peak in the 1920s, reached about $100 million, roughly $2 billion in today's dollars. For a time, he ranked among the richest men in the world. His principles: focus on market leaders and never let small losses turn into catastrophic ones, remain timeless for retail traders. Fast forward to the 1970s, and you'll find Seykota. Starting with modest accounts, Seykota applied strict trend-following principles and computerized trading models. Over time, he compounded small sums into hundreds of millions of dollars. His philosophy was simple but brutally effective. Survival comes first, profits second. Seykota once summarized his approach with striking clarity. The elements of good trading are 1. Cutting losses, 2. Cutting losses, and 3. Cutting losses. If you can follow these 3 rules, you may have a chance. Then there's Michael Marcus, who reportedly turned $30,000 into $80 million during his career. Or Richard Dennis, who started with less than $2,000, borrowed another $1,600, and went on to build a fortune of roughly $200 million. Dennis famously trained a group of ordinary individuals, later known as the turtle traders, to prove that with the right rules, anyone could learn to trade successfully. Many of those turtle traders went on to become highly successful themselves, earning millions in the markets. In more recent decades, traders like Dan Zanger and Mark Minervini have carried the torch. Zanger turned $11,000 into $42 million in less than 2 years during the late 1990s tech boom, not by guessing or gambling, but by identifying the strongest stocks in powerful uptrends. Minervini, a 2-time U.S. investing championship winner in 1997 and 2020, emphasizes the same lesson. Money flows into leaders, not laggards. His message to retail traders is blunt. If you can't make money in the best stocks during a bull market, you won't make money anywhere. What ties all these stories together isn't luck or secret information, it's discipline. Each of these traders understood 2 core principles that every retail investor must learn. 1. Identify leading stocks in strong trends. Markets reward strength, not weakness. Leaders in their industries, showing both earnings growth and price momentum, attract the bulk of investor capital. That's where the odds tilt in your favor. 2. Cut losses quickly. This is the golden rule. Losses compound against you far faster than gains can save you. A 10% loss requires an 11% gain to recover. A 50% loss demands a 100% gain. And a 90% loss? You would need a 900% return just to break even. That's why professional traders obsess over cutting losses before they spiral out of control. For retail investors, this lesson is more critical than any Buffett quote or Dalio principle. Because unlike billionaires, you don't have decades or unlimited capital to recover from devastating mistakes. You must survive first. And that's the essence. Learn from traders who started where you are, not from billionaires playing a completely different game. Don't try to be Buffett. Try to survive long enough to become consistently profitable. Once you master survival, profits will follow.
If this video gave you a clearer picture of why most people lose money in the market, don't just walk away. Do something with it. Hit like, subscribe, and share this with someone who needs to hear it. Remember, the majority of retail investors never make it, but that doesn't have to be your story. With discipline, risk management, and the right lessons from those who started as small traders, you can avoid the traps that wipe out most beginners. The market will always test you. The question is whether you're willing to approach it with the mindset of survival first, profits second. If you are, you've already set yourself apart from the crowd.